day Viru said to Jay, Jay, let's have a party. So Jay asked Viru, do you have money in your pocket? Viru said, Arey, I do not have money, but I have borrowed from my friend Ramesh and invested in a hot stock market tip, which my uncle has given. It surely will get double in 1 month. Now 1 month passed, but after that stock was down by 50%. And Viru was as usual in a big mess. Well friends, we have just seen one of the leading example of how people lose money in the stock market. Friends, my name is CA Tapan Doshi. I am a founder of InvestStars Firm and a stockbroker. In my stockbroking career, I have seen many investors losing money because of many profound reasons. So let us go through one by one. First reason is doing intraday trading without any knowledge. Now let's take example of our good friend Viru. Viru started initial intraday trading, let's say rupees 10,000 capital. The first day he was lucky and he earned rupees 150. So his confidence grew up. The next day again he earned rupees 200 and third day rupees 300. By now he started dreaming of conquering the whole world with his intraday trading skill. Frankly speaking, when I was trading in the initial days, I was also thinking like that. But then the bubble burst on the 5th day and our dear friend Mr. Viru, who was so confident that he did not put any stop loss, and on the intraday he was having a loss of rupees 6,000. So almost more than 1/4 of the wealth eroded in a single day. So to recover its lost money, he invested more capital and started trading again. But the market continued the same cycle and eventually Mr. Viru was out from the market after 2 months with heavy losses. So our learning is here is that before going on full day intraday trading, you have to learn intraday skills. Do not jump in the water unless you do not have safety gear on your body. Now second quality is herd mentality. You must have heard that famous Bollywood song, Hum Saath Saath Hai. But sorry, this terminology does not work in stock market. Just because your friends and relatives are buying a stock, there is a FOMO factor coming in your mind. What is this FOMO factor? FOMO factor is fear of missing out. Retail investors do not do any proper research and they buy any stocks because everyone is buying. But retail investor does not understand that at highs, already big institutions are getting out of the stocks after minting money. So stock prices crashes and what remains in the investor hand is the empty ball. So learning here is that the retail investor should invest only when they have done a proper research of the company and know the company's price trends and financial trends. Now third is social media influence. Every morning if you open TV, WhatsApp, Telegram or any other channel, you will see so many business channels shouting at you, telling you to buy X stock, Y stock. Social media is good, but sometimes social media influence you to invest in some stock where there is a false promise that will double, triple your money quickly. Now think about it. If someone doubles the money quickly, then why they are making a social media post and videos to earn money? They will show you how much they make you earn, but they will never show you money you will lose if the prediction does not true. Sometimes they are paid or have intention to enter you in the particular stock tip so that you can sell the stock, they can sell the stocks and make a profit, big profit out of it. So learning is do not follow social media stock recommendation unless you have done a proper research on that stock and you are aware of it. Now the fourth point, lack of patience. Patience is one of the keys to success in the stock market. Let's take example of our friend Viru. So Viru bought a stock at rupees 100 and in his mind he always think once you buy any stock it should go up. But it tanked 20% and it reached rupees 80. So now Viru started shivering because he was staring at a significant loss. So he decided that he will sell that stock once it reaches rupees 100. That is his cost price. Once again, stock came to its cost price and he happily sold the stock. He was in great relief. But then what happens? It goes up by 50% in next 6 months. So again, Viru got upset seeing that he was not patient enough to reap that benefits. People do not analyze the reasons for the stock losing 20 to 30%. If the reason is due to external factors rather than change in fundamental of the stocks, holding that stock for a few more months may prove to be fruitful. So learning is that the only thing you need to do in the stock market is buy good stocks and give them time. Fifth is lack of proper knowledge. Taking of our friend Viru example, Viru has seen in the media a recommendation of a particular APC stock. So he told Jay, let's invest in that. So Jay asked you question, what is that company doing? What is its EPS, P ratio, net profit? Jay said that I do not know this, but I have a gut feeling that, and also that analyst said that particular stock is good. Now this is a disaster recipe for investing. You first Your first step towards investing in the stock market should be learning about it from the many sources as possible. How does it work? What are the risks involved in the share market? What are the dynamics of the markets? Unfortunately, many retail investors do not have adequate knowledge about the market and blindly invest in stocks based on gut instinct and recommendation given by the experts on financial news channel or websites. Once they invest, they do not know when to get out and eventually they get stuck in that stock if the stock prices fall from there. So, learning here is research of any stock which you invest is very much important. Now, sixth, controlling your emotions. The first thing which people during a loss is increase their lot size for quick recovery. As a matter of fact, if you made loss earlier, there is no guarantee that you would not make it again. When it comes to money, either of the two emotion dominates, greed and fear. Most people lose money or fail again in the stock market not due to lack of intelligence, but due to the inability to control emotions while making an investment decision. Therefore, controlling emotions which will play a significant role in whether you will be successful investor or not. So learning here is that you should have a proper emotion check while investing. Seventh point, act on a half-baked news. Actually, this happens to many people. Suddenly, news sources publish some news about the company and stock prices go on upward direction. It is very impulsive to buy this stock as you see many people making money based on half-baked news. So, you also jump in the wagon. But sometimes later, when the company discloses the correct information and the stock prices goes down, people lose lot of money in the market. So you should ignore all this. Eighth is putting all money to one stock or one sector. Warren Buffett said that do not put all your eggs in one basket, but most people invest their money into one stock or one sector. This is one of the biggest mistake in the share market. If any issues with this company or sector, that will be a huge loss, and after losing they leave the stock market with a red handed. So this is the thing. So this was the common mistake which normal investor makes in the market. Please like this video by clicking below icon and subscribe to my channel. If you want to know more about the value investment, you can click below links which is already given. Me CA Tapan Doshi signing off. Thank you.